Hello everyone, thank you for joining us today for our Net Wealth Portfolio Construction webinar series, which is our series designed to help you uncover unique investment and portfolio construction insights from wealth management professionals. I hope everyone is doing well today. My name is Josh and I'm a part of the marketing team here at Net Wealth, and today I'm pleased to be joined by the two founding partners of Daintree Capital, Mark Mitchell and Justin Tyler, who will be sharing with us their insights on building a fixed income portfolio, considering the range of different options available, such as term deposits, fixed incomes, absolute return funds, listed hybrids, and more. Before we get started, I must run through some quick housekeeping items. Firstly, the views expressed in this presentation are those of the author and presenter and do not necessarily reflect those of Net Wealth and do not represent an endorsement of any product or service. Any person considering a financial product or service from Net Wealth should obtain the relevant disclosure documents from our website and consider consulting a financial advisor before making a decision. It is also important to note that this webinar has been allocated one CPD point, and the details will be sent to you in a follow-up email in the next couple of days. To get the CPD point, you need to be watching this webinar for at least 30 minutes. This webinar is being recorded, and a copy of the recording will be sent along in the CPD email. If there's anything you would like to ask Mark and Justin in today's session, please do so via the questions panel to the right of your screen, and we'll endeavour to answer these at the end of today's session. If you wish to share anything about this webinar on social, we ask that you please include hashtag NetWealthInvest or at NetWealthInvest. So a little bit about who we are. If you're not familiar with Net Wealth, we are an ASX listed company who provide a range of investment and super options via our online platform. As a specialist platform provider, Net Wealth provides financial advisors and investors with a wide range of financial products and services. As a platform, we're consistently awarded for our overall functionality, customer satisfaction, reporting, and transaction tools. What our users love about our platform includes our robust portfolio management tools, allowing you to buy, sell, and track super and non-super investments in one place, powerful reporting tools, and comprehensive investment research tools. If you enjoy the Portfolio Construction webinar series, you might also enjoy our podcast series, where you'll be able to hear from fund managers such as Roger Montgomery, BlackRock, T. Rowe Price, Ausbil, and many more. To find out about this series, please visit the Insights page on our website or simply search Net Wealth Portfolio Construction on your favorite podcast channel. Now, on to today's main event. I'm sure the listeners are keen to jump straight in, so I'd now like to hand over to Mark and Justin to deliver today's presentation.
Thanks, Josh, and good afternoon, everyone. My name's Justin Tyler. I'm a co-founder and director of Daintree Capital, and it's a pleasure to be talking to everyone today. I'm just trying to move the slides forward, Josh, by the way. I'm not having much luck. There we go, that's better. The topic of our discussion today is exploring the opportunities and challenges in fixed income investing. Now, before I get into that topic, though, as was the case with Josh, we have some legalese that I'm going to display in front of you just for a few seconds, and there won't be a test at the end for that. There we go. We'll move forward. Okay, on to today's agenda. I'm going to talk about a few things, and then I'm going to hand over to Mark, who will talk about some other bits and pieces here. But the overarching agenda is firstly the key concepts of fixed income. So fixed income is an area of the market that is notorious really for jargon. We're going to try and demystify some of the key concepts that you need to be aware of. The second part of the presentation is going to be some of the common pitfalls in fixed income investing. Thirdly, we'll talk about, I guess, the products that are available in fixed income, And then we'll end with a market outlook and I guess a brief overview of Daintree's products. So let's get straight into it. Jargon 101. This is the key concept of duration in fixed income. Before I get to it though, I think it's actually a good thing to do in these presentations to get a bit of audience involvement. And so before I jump into the jargon, I've got a polling question here. So Josh, if you'd like to bring up the first one. Before I ask it, I think it's important to note that these results are, there's no right or wrong answer here, but we are interested in everyone's views. And the first question that I have is, why would you invest in fixed income rather than cash or term deposits? And there's three options there. Firstly, a higher return. Secondly, a higher income. Thirdly, better protection in a multi-sector portfolio, particularly better protection versus other things when equities fall. So I'm interested in your views.
Okay, and we'll just allow a few more seconds for the audience to get in their results before I read these out. Okay, so let's close the poll. So 57% opted for better protection than equities, 35% opted for higher return, and 34% opted for higher income.
Great. Okay, thanks, Josh. That's an interesting result. The higher return, so the better protection versus equities when they fall is an interesting topic that we're going to talk to a little bit today. But before I get to it, as promised, key concepts. So the first one in this jargon-heavy area of the market, there's one word that many of you might have heard, and it's duration. I just want to mention it quickly because it'll come up a bit later. Many bonds have a sensitivity to interest rate movements, and that sensitivity is called duration. So in simple terms, long duration means a high sensitivity to interest rates. And it typically means that the more interest rates move, the more you're going to see price fluctuations. And, long duration therefore means a higher sensitivity to interest rates and therefore higher risk as well. Linked to that, and again, Josh, there we go. Linked to that is this concept of the yield curve. All bonds pay a yield, but you might expect that the longer you invest for, the more you get. So, the higher your expected return should be. And you can see on this chart what the Australian government bond curve looks like at the moment. And indeed, that's the case. There are higher yields on offer if you lock your money away for a longer period of time. But of course, that comes with higher risk as well, because those longer bonds do come with higher duration. The next key concept is credit risk. And this is one that I think many people really need to be aware of, because a lot of the products that are available in fixed income space do feature credit risk. And in simple terms, credit risk is the chance that you lend money to a company as opposed to a government, and that company just decides to not pay you back. And it does happen. You can see on this chart here, there's a bunch of numbers, but this is basically the likelihood of not being paid. And on the left-hand side, you can see measures of credit ratings. Credit ratings are given by agencies like Standard & Poor's and Moody's and others, and they rank from the top, AAA, that's the Australian government, down through AA, single A, triple B, etc., and down to the bottom, triple C, which is a triple C company is one that's very unlikely to pay you back. You can see the red circled area there. That's the difference between triple B, which is the bottom of what we call investment grade companies, and double B, which is what we call the sub-investment grade or high yielding companies. And there's quite a jump, isn't there, between the triple Bs, which on average will pay you back. Maybe there's a chance that they default at a lowish one, and then double B, that chance of not being paid back jumps dramatically. So that credit risk is really something that that investors need to be aware of, because if you are being paid a higher yield, you're probably taking some risk to earn that yield. And often when you're investing in corporate bonds, the risk that you're taking is credit risk. And as I mentioned, if you're taking credit risk, you need to be paid for it. And how are you paid? Well, it's a higher yield, and in fixed income markets, how we measure that higher yield is versus the government curve. So the government is I guess classified as your risk-free curve. And you can see again, we've reproduced the government curve there, the dark green line that I showed in I guess 2 or 3 slides ago. The light green line is the sort of yield that you might get paid for investing in part of the credit market. You can see that there's a differential between the two, and the longer you go, the wider that differential becomes. So it's again this concept that if you're investing for a longer period of time, you should expect to get paid more for that. And again, this is something that's really worth being aware of as an investor, because if you do lock your money away for a period of time, if you take a reasonable amount of interest rate risk, a reasonable amount of credit risk, or indeed both, that will come with a higher yield. And you just need to be aware of the risk that you're taking to earn that higher yield. So Josh, now I have another polling question if you want to bring that up. And the second question we're going to ask today is about risk in fixed income. I'll just wait for the question to pop up on the screen. Here we go. And the question is this: on a scale from 1 to 5, how willing are you to accept occasional losses on your fixed income in return for a higher income or a higher yield? Just give everyone a few seconds to answer that one.
Okay. So we'll just close the poll now. So on a scale of 1 to 5, 38% was a 2, 27% was a 3, 16% was a 1, 14% was a 4, and 5% was a 5.
Great, thanks Josh, thanks for that. Again, they're interesting results because it indicates that perhaps the majority of people are willing to take some risk in, I guess, accept occasional losses on fixed income in return for a higher income, but almost 20% of the webinar participants are not willing to do that. So that's an interesting result, because one of the main differences between fixed income and cash is that if you invest in cash, your mark to market risk, that is to say the daily sort of volatility you'll see in the value of your investment, is going to be very, very low. But in fixed income, depending on how much of one of these risks that I've outlined, how much of it you decide to take, there is a degree of risk, and you will see some volatility. And so for that 20% or so of people who said that they were very not very willing to take risk, well, 16 is more than that, 16% not at all, 38% and 27%, so it's probably the majority. It's really worth knowing, if you're getting paid an extra yield, what you're getting paid that yield for, because there is going to be some some risk involved in that. So I'm going to stop there for a moment. I'm going to pass over to my colleague Mark. He's going to talk about some of the common pitfalls in fixed income. We'll move on to the next slide. Josh really seems to have lost control there again. There we go.
Can we go back a slide, Brian? Good afternoon, everyone. Thank you, Justin. Thank you, Josh. My name is Mark Mitchell. I, along with Justin, one of the directors and co-founders of Daintree Capital. And thank you so much for dialing into the webinar. As Justin said, I'm just going to talk a little bit about some of the things that we see as common pitfalls in fixed income investing. We do spend a lot of time with individual investors and with financial advisors, and these are some of the things that, in our opinion, come up over and over again, and things that you just want to be very mindful of. So we'll go through each one of these in a second, but these are, I think, things to be very mindful of and aware of when you are looking at your asset allocation and looking at fixed income specifically. So the first one has to do with passive investing and chasing performance. So everyone would be aware that there has certainly been a lot of money that's gone into passive investing over the past few years, and particularly with respect to listed equities. But there also has been increasingly more money going into passive fixed income products. And our very strong conviction is that people need to potentially rethink that. And the reason why is, if you look at the chart on the left, excuse me, the chart on the left is made up of three different components. The dark green line there is the yield. Now we're looking here at the Aus Bond Composite Index. And effectively, this is the most commonly quoted fixed income index in Australia. If you look at a lot of fixed income products, they will be managed or quoted against this index as a relative measure of their performance. And if you see the dark green line there and you go back on the left-hand side, you're looking at the yield of that portfolio over 10 years ago, it went from roughly about 6% now down to about 70 or 80 basis points. So the yield has gone down, and as Justin explained a bit earlier, yields and prices in fixed income move inversely. So when the yield goes down, the price goes up. So what that means is that you've had pretty good performance of that index over the past decade. So sort of the middle, so the green bars there are showing how that index has done each year over the past 10 years. And on average, it's done about 4 or 5%. So if you're looking at your statements and you see the performance, you've probably been pretty pleased. Okay, this investment's done quite well for me. But there are a couple challenges with that. So firstly, you can see that the light green line going from the bottom left to the top right is duration that Justin was talking about before, and very important concept. So the duration in that index has gone up quite substantially from over 3 years to over 6 years. So that's a measure of interest rate risk. So the interest rate risk has increased quite substantially over that time, and the yield has gone down to a fraction of what it was in the past. It's sort of like we refer to it as, going to get a homeowner's insurance getting quoted, and you get a fraction of the coverage now from what you used to get 10 years ago at a substantially increased cost. So and the only way that sort of performance can continue is if rates continue to go substantially lower. In other words, they actually go negative. So we certainly don't think that's the case. So it's a really important concept when you're looking at your fixed income allocation. And on the right, you can sort of see some of the more commonly quoted large passive fixed income funds globally. They have had a good run in part because of their duration, but we have a pretty strong conviction that that's probably not going to continue into the future, unless you think interest rates are going to go materially negative. One of the other things that we see in terms of pitfalls of fixed income investing is people just sort of chasing yield. And it's very natural to do. People are trying to get the best yield they can for the lowest risk. That all sort of makes sense. But it's important to understand that when you're investing in a passive way, effectively what you get is just the market that's on offer, and if the composition of that market changes over time, then obviously what you're getting in a passive product changes over time. So you can see there on the left-hand side what that does. Those credit ratings that Justin was talking about a little bit earlier, you can see sort of the AAA being the safest, and in this case, this is a Moody's scale, C, AA, or CCC being the lowest. When you go through recessions and when you go through periods of market volatility and uncertainty, the default risk on those particular bonds clearly increases. So the weaker the business, the more likely it is to default. And so you can see sort of the triple Cs and single Bs will certainly go through periods where there are defaults. So just being mindful of that, if you're a passive investor, you will expose yourself to that unless you're making an active decision to avoid those at certain times in the cycle. The slide on the right is a simple example of that. It looks at in the US and globally, the percentage of the market that's made up of triple B assets. So these are still investment grade, but there's sort of the lower end of investment grade, and you can see that over time, more and more of the market is made up of those triple B assets. So if you were just taking the broad market exposure, whether you recognize it or not, you would be increasing the risk in your portfolio. So nothing necessarily wrong with that, just important to understand the risk that you are taking. Direct investing in bonds. This is a very significant one for me personally. I have quite strong views on this. So the chart there on the top left, what it's trying to show is something in fixed income called this concept of asymmetrical risk, which basically what it means is that when you buy a bond, let's say you pay $100 for it, probably the best case outcome for you is and let's say it's a 5-year bond, is to get a coupon every year or twice a year for 5 years, and then get your principal back at the end. The bond is never going to go from $100 to $500 like it will with an equity. Basically, there's not a lot of upside, but there is a substantial amount of downside. It's different than say when you're investing in an equity portfolio, where an equity portfolio, you can buy 25 stocks, 20 of them can lose money, and the other 5 do so well that they more than pay for the losses. That doesn't really happen in fixed income investing. So what that really means is that it's very much about being defensive, protecting the downside, and avoiding losers, and not necessarily picking winners. And so in that sort of environment, it's extremely important for you to be well diversified, because unforeseen things happen. And if you have a concentrated portfolio and any one name blows up, it can substantially hurt your performance. And so you can see there are a couple examples there on the right-hand side. These are some companies that have gotten into trouble in Australia over the last few years. Mackay Sugar is one people are probably familiar with. That company got into trouble, and bondholders ended up getting about 50 cents on the dollar. The most recent one is Virgin. There might be some people on this call who had exposure to Virgin, and they ended up going through a resolution process, and bondholders getting about 10 to 13 cents on the dollar. So it's extremely important to be well diversified. And when you're constructing your own portfolios, unless you're very, very wealthy, it can be hard to get, in our opinion, the diversification required to avoid these sort of negative events. And so, we think a portfolio of probably at least 100 different issuers is reasonable in the investment grade space, and in the high yield space, the number's much higher. One of the other things that we see in people who invest in fixed income products in Australia is a lot of them are just sort of focused on the Australian market. And the Australian market is a good market, and we have, in our funds, we invest a lot in Australia as well, but it is a relatively small market compared to the globe, and you can sort of see on the right-hand side a very small part of the global bond market. So you certainly limit your choice if you don't look offshore. And there on the right-hand side, what that chart is looking at is the spread, or the compensation, the credit spread that Justin was talking about earlier. The credit spread that you get paid for taking that exposure, and the light green line is Australia, and the red and blue lines are the offshore markets. And it just makes the simple observation that there are times when you have very significant dislocations between the Australian market and the global market, and it's you just want to be able to shop for value, and it makes sense to be able to look around. So just be mindful when you're looking at products that only look at Australia, because you are limiting your universe. I think we just have one more polling question, actually. Josh, would you mind popping that up? Promise we'll stop annoying you guys with polling questions after this. The last question here, on a scale of 1 to 5, how reliant are you on equities to provide income? Not 1, not reliant at all, and 3, very reliant. And the reason we ask this question is because we know that there certainly has been more and more people looking at sort of equity income style funds, given where the absolute level of government bonds and TD rates are. So just curious the thoughts of the listeners. We'll pause there for a second.
Yep, and we might just end the poll there. Okay, so 40% have rated 3 on reliance, 25% have rated 4, 17% have rated 2, 10% have rated 1, and 8% have rated 5.
Okay, thanks for that. I guess that's broadly what we've expected. Not too many 5s, but certainly a fair few 3s and 4s. About 65% of you saying that 3 and 4. So there is a reasonable level of reliance on equity income and dividend style income. So that's something quite important to understand as we sort of go into our next section of the presentation. So just taking a broader look at fixed income as an asset class. And so in our conversations, I mean, we've had hundreds of conversations over the years. And what we find is that there's sort of 2 reasons that people do invest in fixed income, sort of aligned with Justin's question earlier. And one of them is to provide a more regular income or a higher return than you're getting in your cash or your term deposits. And the second reason is more around being able to sort of diversify your portfolio and hedge out potential risk, but specifically listed equity risk. You know, if you're worried about your equity exposure selling off in a down market, you go out and you buy a fixed income product, a long duration product, and your hope is that that will hedge out the equity risk. So there are pros and cons to both of those approaches. When you're looking at an income style fund, you know, you probably don't have as much duration. But you are taking credit risk, as Justin talked about earlier. There is a default risk. There's a risk that the issuer will go out of business and not give you your money back. But it does that style of fund doesn't necessarily provide you with a lot of protection against an equity sell-off. And then the second approach being more sort of a duration-focused approach. In the past, that's worked reasonably well to sort of help out hedge out some of your equity risk. But it certainly does come with you know, a lower overall yield. And greater interest rate risk. And so we'll talk about that. You know, the question is, does that sort of approach make sense in our new world? So we think it's quite important when you're looking at any sort of investment option. There's really two characteristics that you have to take into consideration. Well, excuse me, there's quite a few, but 2 important ones. Are your risk tolerance and your time frame. So with a very simple observation that clearly the higher risk, the longer your investment horizon needs to be, because the market volatility, if you get your timing, if you're unlucky with your timing, you know, you might have something that has a good income or a good yield, but the market can be down 10, 20, 30%. And it might take you years to earn that sort of capital back. So here you can sort of see, you know, we sort of broadly look at these style of income, and often will be characterized as sort of non-equity or defensive style allocations. You know, things that like equity income funds and property funds that tend to focus, you know, kind of higher levels of income, but clearly they have much higher levels of risk. And it's really important to understand that if you are going to invest in those things, you certainly need to have a longer time horizon. Whereas if you're looking obviously at if your focus is simply on capital preservation and you don't really care about income or growth, then you might want to look at a government guaranteed term deposit or sort of a short duration government bond fund, so you don't have a lot of duration risk. But we do see at times people who invest in products because they are attracted to the yield when they actually, you know, need the money in 12 or 18 months to pay for a deposit on a house or to pay for university. And it's just something to be mindful of. You don't necessarily want to have this sort of market exposure if you don't have the aim to hold it for a long enough time. And just looking at some of those products, this probably won't surprise anyone on the call, but the more risk that you take, the more the drawdown can be. So we've just sort of looked at some representative indices here. And what the drawdowns can be. And obviously March this year was a fantastic reminder of, you know, markets clearly can be down very quickly and in substantial quantum. So it is important to understand, just because you're taking understand the volatility and downside risk that you're taking. Most people, you know, when they look at a prospective return, they'll probably look at the average return. And obviously if the return is higher than that, they'll be happy with that. But really, we think it's very important when you're looking at any sort of asset It's the downside case. It's the what's the worst that can happen, and that should sort of, in our opinion, be the bar for whether or not the investment makes sense for you. Not what the average return is, but can you handle the drawdown? Can you handle the downside mentally, emotionally, financially? And probably sort of use that as your litmus test as to whether or not the asset necessarily makes sense for you personally. And it's important to appreciate that there's not necessarily any ever good or bad investment, and what's a good investment for your neighbor or your friend may not be a good investment for you. It's all about your personal circumstances and your risk tolerances and what makes sense for you. So a higher yielding product is not necessarily the best investment. Just briefly on exchange traded products. I'm sure there are some people on this call who do like exchange traded products. We just wanted to make a couple of quick top observations. On the left-hand side there, you can see some of the categories of some of the various exchange traded options that are out there. We sort of grouped them into these 5 different categories of long duration, simple credit beta, sort of IG type beta, things that are more benchmark unaware, listed investment trusts and LICs and hybrids. They all have pros and they all have cons, and it's just important to understand, sort of as we were saying before, you know, it just makes sense to think about if it makes sense for you in terms of what your risk tolerance is and your investment horizon and what you're trying to achieve. As Justin was saying earlier, you know, the fixed income market is quite diverse, and you really have to dive in to understand exactly what a particular product is trying to do. And you know, equities, I think for the most part we can understand, you know, they focus on different regions or sectors, but generally straightforward. But these the bond market is a little bit more diverse, so quite a different sort of range of structural features and risk that you have to understand when you're considering this space. So just to sum up, and I'll pass it back to Justin. You know, we do have a view that it's really important to be clear on what you're trying to achieve when you're looking at income or defensive oriented investments. Generating income is not the same thing as being defensive. You know, we view defensive as being the risk of permanent capital loss. You know, the risk that something sells off and you actually lost your capital that you're never going to get back. That's our view of defensive. So if you're trying to avoid that, that's defensive, as opposed to something that's income chasing. It may not necessarily be defensive. Time frames for your investments are extremely important. Make sure you have the ability and willingness to hold the investment long enough when you're taking more risk. We mentioned some of the pitfalls that you might just want to consider when you're looking at fixed income, and important to understand all those risks that Justin outlined before about credit risk, duration risk, and equities. So with that, I'll pass it back to Justin.
Thanks, Mark. And look, for the remainder of the presentation, I'm going to talk a little bit about how we see the world in over the next little while, and link some of those points back to what we've been saying. As you can see here from the cartoon, the world is going to be very much about debt. Right? If there's any certainty that we can point to over the next little while, it's that government debt levels, state government debt levels, even personal debt levels are going to be, you know, quite a lot higher going forward than what they have been in the past, and that's something that that I'll address in the coming slides. But I guess as a preface, I would say that in Australia, there's been a real aversion at government level until this corona virus-led recession. There had been a real aversion, I should say, to taking on debt. Indeed, if I cast my mind back to 2003, I can remember Peter Costello questioning whether there was any need for the government to participate in the bond market, because at that point the budget was in surplus. And of course, history will show that the bond market was retained, and that indeed was a good decision, because these things move in cycles, sometimes very long cycles. Obviously now we're in a different part of the cycle with debt having increased. But the point I would make is that at a government level, debt is not necessarily a bad thing. And I think the aversion for all those years was actually misplaced, because ultimately, if government spends the money that they've been borrowing in a way that's productive, you know, for example, by updating aging infrastructure, and there are many other ways, then that sort of debt can be a good thing, because the payoff more than offsets the cost of the interest cost. And remember, at the moment, interest costs on government debt are very, very, very low. So I would say anyone pointing to government debt levels and saying, you know, that this is a problem for future generations, perhaps not so much, because it's not about the debt itself, it's about how that debt is used. However, when you're looking at personal circumstances, then of course it can be a very different story. You know, there's no real way of equating debt at a personal level or a company level to debt at a government level. They're very, very different things. So in this world of low interest rates, just moving on to the next slide. The slides are a bit stuck again. There we go. I think one of the real changes that we've seen in investment markets over the last quite a while, actually, but particularly in the short term, you know, over the last several months, one of the things that we've seen is that capital growth is actually really quite easy to find. If you have sufficient risk tolerance, if you have you know, ideally sufficient wealth, then it has been very easy to make money in the markets that we've been seeing. Now, why is that? That's the question. If you have a look at the left-hand side, I'm going to put it to you that the market environment for equities and for other sort of more risky assets is inextricably linked to the market environment for bonds. You can see on the left-hand side that over a very long period of time, interest rates have been falling. The light green line there just shows you the yield on US 10-year government bonds, and I could easily put any number of different interest rate measures there, and they would all show the same thing, that you've seen really a very long-term fall in interest rates, and that's been driven by inflation being first brought under control by Paul Volcker when he led the US Federal Reserve in the late 70s and early 80s, and then laterally by other central bankers, you know, effectively kept inflation under control. That's underwritten a real structural move lower in interest rates. And of course, when interest rates move, that doesn't just impact bond prices, it impacts equity prices as well, because one of the central, I guess, tenets of finance, and one of the central tenets of valuation of any financial asset, is that a financial asset gives you future cash flows. And as interest rates fall, those future cash flows are worth more. That's just a constant in terms of all, you know, I guess, valuation. And so therefore, as interest rates have fallen, that's been one of the drivers actually of equity markets doing well. That's been the case over the long term. It's certainly been the case over the short term. However, there's a circularity there, because as equity markets have done well, and property markets, that's another asset class, residential property is also driven by interest rates. Lower interest rates have certainly put a rocket under housing prices in Australia over several years. But what that's done is that, firstly, it's led to increased debt levels. You know, most consumers now in the sort of home buying phase of their lives are much more heavily indebted than perhaps previous homeowners were in the 1970s and 1980s. The second thing that we've seen is that we've seen increased wealth, because people increasingly participating in equity markets, in property markets. That has increased people's wealth, but also we've seen increased wealth disparity. You know, and the well-known rhetoric around the 1%. Well, you can see on the right-hand chart here that as debt levels have gone up, not only has wealth increased, but so has the share of the top 1%'s income. And all of these things are linked. And so capital growth has been easy to find, but it's really been the wealthy who have benefited most from that capital growth. We look at the other side of the equation, we look at the income side of the equation. Well, yield, on the other hand, has been very hard to find. And that has meaningful consequences for people who are in the pension phase of their life cycle. It has meaningful consequences for those who perhaps have earned a significant sum in capital gains and who now want to protect that significant sum and perhaps earn an income from that significant sum. That ability to earn an income has become much harder as bond yields have fallen. My first slide showed how I guess government bond yields have fallen, and this slide shows not only how yields have fallen just in simple terms, but you can see the share of the bond market yielding, in different sort of buckets, and you can see that the negative yielding bucket at the bottom in the dark blue has been growing strongly since 2015. You might ask, why on earth would someone buy a bond with a negative yield? And the simple answer is either A, because they're forced to, or B, because it suits their investment needs, even when yields are negative. And if you look at insurance companies, for example, they have a real need to buy bonds, even when the yields on those bonds are negative. What I would say, though, is that when you're looking at personal investment portfolios, sort of typical multi-sector portfolio, there is increasingly very little space in those sorts of portfolios for government bonds, because it's government bonds that make up the lowest echelon of this chart. And you can see that also on the right-hand side. Not only are we seeing yields as quoted very low, but when you back out the impact of inflation, yields are even lower. So real yields are negative across the developed world, and that's been the case for a while. If we have anyone on the call who was born in the sort of 1920s and 1930s, they may remember the era of financial repression that happened, I guess, at the end of and post the Second World War. There was a period there where real yields on bonds were very low. They were kept there by governments. I think we're entering into that sort of period once again, where yield is going to be very hard to find. Not only is it hard to find now, but it will remain hard to find, therefore. And why? Well, if you look at the cash rate in Australia, it's at record lows, obviously, but the left-hand chart shows you why. The unemployment rate now is at not so much at record highs, but at the highest it's been in decades. That's a great reason for the RBA to leave the cash rate low, and indeed perhaps even edge it a little bit lower. That says to me that interest rates are going to remain low for the foreseeable future. And the obvious question is, okay, well, what's the circuit breaker? What would be the thing that gets in the way of that? Well, what gets in the way of that is inflation. We haven't seen inflation for at least the last sort of 30 years. But it's our view at Daintree that bond markets should remain unconcerned about inflation, because the right-hand chart shows you what the bond market thinks inflation is going to look like in the US over a long period of time. And you can see that even though it's picked up a little bit, it's very low relative to history. So if inflation remains something that bond markets are not worried about, then interest rates across the yield spectrum are going to remain low. And that has a meaningful implication for people with multi-sector portfolios. Going back to what we've said previously, if you want to protect a multi-sector portfolio, one of the key ways of doing that has been to invest in bonds that have interest rate risk. Because if interest rates fall and the prices of those bonds rise, that's a good thing. And typically that's happened when share markets have been under pressure. What you can see on the left-hand side here is we've drawn a chart of equity performance in Japan. Why have we chosen Japan? Well, Japan is the market that's seen very low rates for the longest period of time. And so it's a useful case study I think, for our future, because if our interest rates are going to behave similarly to Japan, that is stay low for a very long period of time, then it's worth looking at how Japanese assets have behaved as a result of that. And what you can see is that the blue bars show you how equity performance has panned out in negative times for equities, and we've inverted the axis just to make it easy. So a big blue bar means a big negative performance for Japanese equities. If you look at the yellow bars, what you can see there is bond performance in Japan. We've picked government bonds in Japan and said, well, during those periods, you know, when you really needed those sorts of bonds to protect you, when equities have sold off, how have they done? You can see that this is a chart of two halves. That prior to 2010, Japanese bonds did a reasonable job of protecting against most equity sell-offs, but post 2010, they've done very little, if anything. You can see, in particular, the March sell-off, Japanese bonds provided no protection whatsoever. And why is that? Well, the right-hand chart shows you how volatile the bond prices in Japan have been. You can see there was a lot of volatility in the 90s, a little bit less in the 2000s, and most recently, that measure is at record lows. And in simple terms, bonds can't provide protection to you if interest rates and therefore bond prices can't move. We're in a situation now with interest rates at very, very low levels. If they're going to stay there, then that means you're not going to get much of a move in bond prices over time, and bonds therefore aren't going to do much for you in terms of protecting your equities. And so that goes back to the poll that we did earlier, that many of you rely on bonds to protect you. Most of you, if you have that sort of allocation in your portfolio, it's probably going to be a portfolio that follows a widely held bond index. We would say to you that needs a rethink, because if interest rates are going to remain low, that part of your portfolio is no longer fit for purpose. If we look at we've gone too far. If we look at the next slide, those of you who read Livewire and other financial market press, there has been a few articles over the last week or two written by various people saying, look, well, the world is not ended for bonds. You know, those of you who have government bonds in your portfolios, you might still need the defensiveness. Another point that's been made is that we can add value in government bonds, even if government bond yields are low. Well, we can make money for you in that sort of environment by taking views. You know, if interest rates are going to fall, maybe we buy more bonds and vice versa. The bad news for that sort of approach is that, again, you need volatility in interest rates to actually make money. You need to be very good, and B, even if you are very good, you also need volatility in interest rates. And if you look at the right-hand chart, it's pretty clear, I think, when you look at the price of 10-year government bonds in Australia, that those opportunities are going to be very, very slim pickings going forward. So what do you do then? I've put this case forward that we're going to be in an interest rate environment where interest rates remain very low and they don't move very much for a long period of time. What do you do? Well, if you want to protect your equities, we would say that there are four things that you can do in this new world. And I think the most important fifth thing that I haven't mentioned is to not stick your head in the sand. The world has changed. And so as an investor, it's incumbent upon all of us as investors to change given the circumstances that we now find ourselves in. And some of the things you can do are listed here. The first one is to be a little bit more dynamic with respect to your asset allocation. So that's to say, when you're worried about markets, sell some of your equities. Those of you who have financial advisors, some of you might have financial advisors who do that for you. For others who don't have that sort of financial advice on hand, well, now might be a great time to go looking for it, because the ability to be out of equities at the right time, you're not going to get that decision right all the time, but it will more than pay off for you getting it wrong a couple of times and then getting it right and being out when you really need to be out. The second way that you might look is to look at other safe havens. Do you have an allocation to gold in your portfolio? Does your portfolio have allocations to safe haven currencies like the Japanese yen, like the Swiss franc, even like at times the US dollar? Allocations to other safe havens other than long duration government bonds are worth considering at this juncture, as are allocations to options-based strategies. That is, they're commonly known as tail hedging strategies. There are ETFs that allow you to do this. You can buy ETFs that promise to pay out and pay out a lot when equities sell off. The trade-off, of course, is that when equities are going higher, they tend to lose consistent small amounts of money. Think of it as an insurance premium. You are effectively paying an insurance premium away in those sorts of structures for the assurance that when equities do sell off violently, like they did in March, that you have some protection on hand. And finally, actual short equity positions. So it's very clear that if you want less risk in your portfolio, that you should reduce your equity exposure. Some people might want to do that on a more permanent basis by allocating to cash, or indeed allocating to ETFs that give an inverse payout to equity. So there are many things that can be done. It's really incumbent upon all of us as investors to start looking into these sorts of options that are out there. Just finally, I'll give a little bit more on the outlook, and then I'm going to summarise what I've said so far before I hand over to Mark. The outlook, as we've mentioned, is for monetary policy now to do very little. It's done everything it can do. It's very close now to its limits. That has the implications for financial markets that we've already mentioned. Fiscal policy, therefore, on the other hand, is going to be very important going forward. What does the Australian government do in the October budget? You know, our tax cuts brought forward, those sorts of decisions now are going to be important not only for the economy, but potentially they're going to be more important for financial markets moving forward than they have been in the past. Just as it's difficult, I should say, to see cash rates moving lower, then therefore it's also difficult to see government bond yields going too much lower from here as well. And so we've already talked about the portfolio implications of that. And so for those of you who look at that sort of backdrop and think, well, I need to take some more risk in fixed income, you need to be a little bit careful about how far you move down that risk spectrum, because we do expect to see a spike in higher yielding bonds and loans defaulting in 2021. We've already seen what happened to Virgin earlier this year. There are many other airlines globally, entities exposed to commercial property, to other areas of tourism. The list goes on. There are going to be many companies which struggle, you know, when this pandemic, I guess, if this pandemic, I should say, goes on for a long period of time. And indeed, there are going to be some that struggle, even if the economy recovers strongly, because some of them now are surviving only because they have access to cheap financing. And if that financing line that they have in place comes under pressure, then that's going to have a meaningful impact on their survival prospects. Share buybacks and dividend payments have been a mainstay of equities going forward. Earlier on in the poll, many of you indicated that you've been reliant on equity dividends. Many of you, therefore, are going to be aware that that reliance really depends on the willingness of the company to pay. We've seen the big four banks, for example, cutting their dividends for the first time in a long time. Companies do have that option. If you rely on dividends for income, you have to be aware of the fact that that dividend income can be cut. With bond markets, on the other hand, even though yields are lower, at least you know when you buy into that sort of product, you know what the return is going to be when you buy in. Many of you might be aware of the vaccine prospects. There's many out there. There's so many at the trialing stage, actually, that I think the potential for the market to be disappointed by any one of them is actually quite low. So our outlook for equities and risk assets is quite strong at the moment. That's one of the reasons. But there is a big dislocation between market fundamentals. Despite that quite bullish prognosis that we have, we would still acknowledge that there's a mismatch between fundamentals at the moment and the strong support that central banks are providing to equities. And we think that it's that latter factor that's really driving equities. And in some cases, equities are quite expensive. So there is no alternative, and the fear of missing out, those sorts of dynamics are really driving equities at the moment. That's something that everyone who's investing in that market needs to be aware of. So I'm just going to hand over to Mark in a moment. We've got a summary there of the things that we've been through. Just very quickly, interest rate risk, very much less effective going forward as a protection. Going to be much harder for people who run those sorts of portfolios going forward. That argument extends to passive investing as well, as Mark mentioned before, much less compelling in the current environment. So it makes sense to look for well-diversified and actively managed strategies, and particularly in the credit market when you can get paid a reasonable income. And with that, I'll hand back over to Mark.
Thanks, Justin. Thank you, everyone. Look, just conscious of time, we just spent a few minutes just giving you a brief introduction to Daintree. We don't want to give you a hard product sell, but we were asked just to give a high-level overview of the product that is available on the platform. Here, a slide talking about our investment philosophy. After having listened to us talk for a little while now, probably nothing here is a surprise to you, but our approach to fixed income investing is that we're an absolute return investor, which basically means we don't pay attention to fixed income benchmarks. We're trying to give you a positive return every year, almost independent of what markets are doing, as best we can. Strong believers in active management of fixed income rather than passive. Capital preservation is very much an obsession with us. We're very much here to protect your capital and not to lose it for you. So that's something we focus very, very highly on. And obviously, we do have a global focus, as we highlighted before. Just a very brief introduction to our two products. Our main product is called the Core Income Fund, and this is available on the platform. It targets a cash rate plus 1.5 to 2%. And we have a high return-seeking product called the High Income Fund, which is cash plus 300 to 400. I'd also highlight, you'll see there in the dark green, there's a ticker ECOR, eCore, and EMAX for high income. We also have exchange-traded versions of these products. If it issued by eInvest is our partner there, if that's of interest to you. So the exact same products are available in listed format. But in terms of the Core Income Fund, yeah, just a global investment grade bond fund, very well diversified, very little credit risk, very little duration risk, pays a monthly distribution, daily liquidity, but importantly, it does have sort of a recommended 3-year holding period. So people who look at this product really sort of a couple of things that they do like, and I'll highlight it here. It is good liquidity. It is relatively easy to administer. Certainly better return than cash. Will help you a little bit, not as much as long duration, but certainly will help you if you have a massive equity correction. But it's really important to appreciate, that it's not government guaranteed. So this is a market product. It does have market risk. It's not a cash term deposit. So if you invest in this product, you do have to understand there will be months when it is down. We certainly do everything we can to mitigate those risks and reduce the likelihood of that occurring, but it certainly will occur, and March was a great example of that. But so in order to do that, you do have to have a high level of diversification and be quite thoughtful about your products. Just while we're on the slide, I would like to caution people on hybrids. I know that a lot of people invest in hybrids. They're issued by well-known banks for the most part here in Australia, and they offer a compelling yield or spread. And I certainly don't want to say negative things about them, but what we have found at times is that people allocate to hybrids and perhaps think that's actually their defensive allocation done. And I just would want to caution against that. If you buy a hybrid and you do hold it to the call, it can certainly be a reasonable investment, but at the same time, you could incur substantial volatility along the way, and the risk of permanent loss of capital. So that's something that we would never consider defensive in our opinion. So not a bad product, but just understand that there are a lot of risks that come with that sort of allocation. And just briefly, just wanted to spend a couple seconds talking about ESG, so environmental and social governance investing. This is probably something that most of you are familiar with. It's quite important to us here at Daintree, and part of the reason why we came up with the Daintree name. Looking at these sorts of things in our investments and considering them not just the economic return, but also sort of the larger impacts on society. And just as a very, very brief introduction, there's sort of three different ways of kind of thinking about environmental, social, and governance investing. The first one is sort of negative screening, which basically says, you won't invest in a certain type of company because of its activities. Here, the example of tobacco, the asset manager just says, look, we're just not going to ever buy any tobacco bonds, or it might be defense or something else. Very simple and relatively straightforward to do, and something that's been around for a long time. Probably the more common approach now, which has become very mainstream, is what we refer to as sort of risk or risk assessment. Perhaps someone might become a signatory to the UNPRI, and what they say is, look, I am going to invest in a defense company, but I'm going to engage with the company. I'm going to make sure they're taking into account all the risks that they wear, and the risk to society and the risk to their business. And I, as an investor, am making sure I'm getting paid for that risk. So I will potentially invest in them. I'm not necessarily going to exclude them. And then the third stage is what we'd probably call impact investing, which is more looking specifically at projects that are tied to some sort of social good. So perhaps you fund a wind farm or a solar farm or public housing or something like that designed as a social good. So those are sort of the three different, if you are thinking about ESG, in our view, those are sort of broadly the three different ways to think about ESG. In terms of our fund, we certainly would say that we do all three of those, but most managers would say that these days. And we have a whole series of exclusions. So if you personally or one of your clients, is concerned about various things that they don't want to see in their portfolio, this is sort of a laundry list of pretty standard exclusions that most people in sort of a social responsible or an ESG style fund would exclude, if that is something that is of importance to you. For Daintree, if you do want to consider a business or a fund like ours, we do think it's a reasonable choice in this environment, and we are partnered with Perennial Group, that many of you would be familiar with, an established value equity manager. But we do think it's, whether you're considering a fund like ourselves or a manager like ourselves, we do think it's important to really sort of rethink, how you have been doing your fixed income allocation, because we do think the world has changed, and probably going forward, what's worked in the past may not necessarily work in the future. So I think we'll finish there. Pass it back to Josh. Questions?
Perfect. Well, thank you, Mark and Justin, and listeners. I hope that's provided you with some valuable insights into building a fixed income portfolio. I do understand it is past 2 o'clock, which is our conclusion time. If you're unable to join us for the Q&A, there will be a recording of today's session, which will be emailed to you in the coming days with those questions in there. So perhaps we'll kick off with some questions. We'll see if we can get through just a couple of them. If you haven't yet asked Mark and Justin a question today, please do so now via the questions panel. If we don't get to ask you a question, I will pass it on to Mark, Justin, and the team to perhaps follow up with at a later date. So the first question here, Mark and Justin, what's your argument for investing in Aussie bonds when I can get the same rate in cash without the risks? Are bonds overvalued?
Yeah, Mark, here, I'll take that one. I'm not really sure where you would get the same rate in cash or even term deposits compared to the type of assets that we would buy. So don't quite understand the nature of that question. I mean, the cash rates are quite low, as we know, at 25 basis points. A term deposit, you would probably be doing well to get something, with a high one on it, or even mid to high ones. And even in that environment, you're probably having to lock it up for a period of time. Perhaps you might have to buy a 5-year term deposit So if that's your preference, that's great. I mean, our fund has sort of an expected return of around 2% or in the low twos, with a much greater level, in our view, a much greater level of diversification. Our main fund has about 120 different companies in it, so it is very well diversified. So the argument for taking that market risk is that on average, roughly, you would get about another 100 basis points over what you'd expect to get in sort of a one-year term deposit. But if running, having sort of government guarantee is really important to you and not having market-to-market volatility, then that's probably something you should consider. Maybe you spread your money across, 8 different banks and get a government guarantee, and that certainly some people will do that. So if your obsession, focus is on capital preservation, that might make sense. But certainly the overall yield in that trade would be less than what we would look.
And the liquidity would also be compromised in that, fund like ours, you can get your money out with a day's notice, whereas obviously in a term deposit, your money is locked up.
Thank you. And this is a two-part question. Do you have any extra comments around the Virgin bond saga? Are there any lessons that you could pull out for investors? And also, what is your view on individual investors holding direct corporate bonds?
Yeah, Mark again here. I'll take both of those. Yes, look, to be perfectly honest, I do feel very sorry for people who invested in Virgin. They actually did a bond deal. Don't quote me, but I think it was roughly around November of last year. And then, less than 6 months later, they basically, because of COVID, pretty much going into administration. And so I don't even know if an investor in that deal actually got their first coupon. So, you would have lost roughly about 90 cents on the dollar. So, and sort of related to the first part of the question there is, buying direct corporate bonds. We're not big believers in it, specifically and Virgin being an example of that, because unforeseen things can happen. You as an individual investor trying to go out and do the analysis on a company and understand what the real risks are of it actually defaulting. You saw the default table that Justin put up, and sort of looking at a 7-year BB rated bond, which is what Virgin was at the time. I think it had over 7 years it defaulted roughly about 10 or 12% of the time. What was the number? So yeah, just under 10% of the time. So 1 out of 10 times, you're going to lose a substantial amount of your capital. It's very, very difficult for an individual to do all of the detailed fundamental work to understand the businesses, the business risk, and the risk of that actually defaulting, and then monitor it on an ongoing basis. Even then, to be fair, you'll still get things wrong. There are fund managers, who have very experienced analysts covering that entire sector that held those bonds when they were defaulting for a series of reasons. But so the short answer, the lesson for me there in terms of Virgin is just be very, very careful, particularly when you're looking at high yielding bonds. I mean, a lot of people might buy that because yields are low and they're chasing a higher return. But, as we sort of tried to outline in this talk, that comes with risk. And so, and if you're trying to build your own direct bond portfolio, you probably need to have, in my opinion, at least 100 different names in that portfolio. So that is a lot of work, in theory, for you to research, and also requires a substantial amount of capital for any individual to go out and invest in that many bonds. So we believe a fund is probably a very highly diversified fund is a better approach.
Thank you. And in the funds you mentioned earlier when you were referencing ESG, are there only 2 funds, or are there others which deal more or less with the ESG issues, or do all your funds take those into account?
Yeah, Mark again here. Yeah, I'll take that one. So our approach to ESG, and many managers will tell you this, is it is embedded in our process. So our analysts, look at the ESG factors of each company that they do invest in. So we don't run a dedicated ESG fund per se. There are managers that do that if that's of interest to you. We don't run that, so we embed it in our normal process. So specifically with respect, governance is quite important, but also we look at environmental and social factors. And so as we highlighted, we do have some screens, so we will screen out certain types of industries. But then the real work is around just assessing the risks of those things and whether or not you're getting paid for that risk, and then trying to engage a bit with management. We're quite lucky. We're in partnership with Perennial, as we mentioned. They actually do have dedicated ESG funds and a couple of analysts there, and so we share ideas, share resources, and often sort of engage with them on various ESG things. So that is helpful for us. But short answer is no, we do not have a dedicated ESG fund, and there are several problems with that. I don't have a lot of time on this call to go into it, but when you are running those sorts of funds in fixed income land, sort of related to the last question, extremely important to be well diversified. So if you're only running an ESG oriented fund, chances are it's either a long duration fund or it's not well diversified, and we don't really support either of those approaches.
Thank you. Perhaps one last question. How has Daintree adjusted their funds over the COVID phase?
Sure. Well, there's been a few things that we've done. Justin here, I'll take that. I think if I start back in March when things were starting to move south in equity markets, one of the first things that we did is we let our cash build up quite substantially. That turned out to be a good thing to do, because there are a number of funds in the marketplace that actually put exit fees on their products as COVID sort of progressed through the world and impacted financial markets, and we didn't have to do that because of the liquidity that built up. So that was good. And then once we were past that and things started to turn around once again, and the market started to strengthen, we did several things. We invested some of the cash that we'd let build up into very high rated bonds of Australian banks. That is to say, we didn't really want to take too much risk with that money. And in fact, we also wanted to ensure that by putting that money to work, that we weren't compromising on our ability to fund redemptions. And that part of the market is one of the parts where it's very easy, to sell those bonds and raise cash when you need to. We've been looking further afield at things that we don't want to invest in as well, because the strength in markets has given us the opportunity to exit some parts of our portfolio that perhaps we don't need to be in. And an example there is airports. Very happy with airports in normal times, but in a time like this, their business model is under serious pressure, and they can only survive with further equity injections. Their shareholders basically have to stump up further cash to fund their operations, and so we don't necessarily need to lend to entities like that. There's plenty of other bonds for us to choose from because we have a global mandate. Similar to that, airlines is a sector that we were never in, and certainly we're not about to start investing in anytime soon. And finally, I guess the final example might be some parts of the commercial property sector. We've all been involved in the work from home dynamic, and we think it's too early to tell just what the long-term ramifications of that are going to be on commercial property.
Excellent. Thank you very much. Once again, Mark and Justin, thank you very much for your time this afternoon, and thank you to the listeners for joining us today. We hope you found this session valuable. Just a reminder that everyone that registered for today's session will receive a copy of the slides and a recording of the presentation in the coming days. And any questions that we didn't get to, I'll be providing this to Mark, Justin, and the Daintree team. So once again, thank you very much, and we'll see you next time.